Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about capital gains tax and talk about strategies to minimise it. Of course, we have conversations with clients on a daily basis about capital gains tax, and it's something that I guess people don't really think deeply about or start thinking deeply about until they consider selling an asset. But therein lies, part of the challenge as well. Is it shouldn't be an afterthought. It should be something that we think about before we purchase the investment and then how we manage that ongoing. But it can be a considerable consideration, both in terms of taxation liability, which is what we'll mostly talk about today, but also as a impediment to make good financial decisions. Sometimes people don't want to sell assets just because of capital gains tax outcomes. And, it's one of the things that people have blamed CBA share price for, that a lot of retail investors own CBA. They bought it maybe when it floated a long time ago. They're sitting on large capital gains. And so the owners of the stock, there's not a lot of depth in terms of them wanting to sell it. And then international investors come along and create a lot of demand for CBA, and of course then the share price rises. So we can kind of see it in a day-to-day basis how CGT liabilities can really hamper good quality decision making. And I think if we firstly understand how CGT operates, and then how we can potentially minimise the impact of CGT, hopefully then that gives us better context for making longer term financial decisions.
So the first component is understanding how capital gains tax works, and obviously the most common example is when you basically sell an asset, so you're selling a property or a share or something similar. But where people sometimes make a mistake is if they transfer an asset that they own to someone that they know or a related entity. So for example, it could be a share that they own personally that they transfer into a family trust. Now, so basically any change of beneficial ownership will trigger capital gains tax. And the way capital gains is calculated is it's added to your taxable income. And now, assuming you're an individual, you'll be paying tax at 47% if you earn above 190,000, or if it brings you above 190,000. Individuals and trusts, if you earn it for more than 12 months, that is, get the 50% CGT discount. So if you own the property or share for more than 12 months, then you can get a 50% CGT discount, meaning that 50% is tax-free, and then 50% is added to your taxable income, and it's assessed at that rate. The difference in these tax treatments is where the planning opportunities are. So it's really important that you work and plan before you sell the asset then rather than after you sell the asset, because there could be opportunities to explore to minimise the capital gains tax.
Okay, one of the components to minimising your capital gains tax liability is obviously maximising or increasing the cost base as much as possible. The higher the cost base, the lower the capital gain, and therefore, of course, the lower the capital gains tax liability. So we need to think about then all the expenses that we can include in the cost base. So that's really acquisition costs. If it's property, it obviously includes legal fees, any fees that you paid to a buyer's agent, any fees associated with property inspections, these sorts of stamp duty, of course, is a big one. These sorts of costs all go towards the cost base. Of course, then there's any capital improvements that you've made to the asset, net of any depreciation benefits claimed. And that's an important aspect, by the way, that the law says that the cost base should be reduced by the amount of depreciation you could have legally claimed, not if you have actually legally claimed that depreciation. So that's an interesting point, because it just means that, of course, we're always going to claim depreciation when we're able to do so, but it really just means that we absolutely should, otherwise we'll be double taxed if we don't. And then any other sort of costs or improvements that you might have made to the asset over time. And this can be really important when we have mixed use assets, a holiday house, For instance, if we have made capital improvements to that holiday house, obviously we don't get the main residence exemption, if it's not our primary place of residence. But again, these sorts of improvements and costs that we have spent on this asset all go towards reducing the cost base. So it all comes back to really great record keeping and making sure you and your holistic accountant are on top of this to make sure that you do have that good record keeping, because it's really challenging for you to work back and think about what are the expenses that occurred 10, 15, 20 years ago. Almost impossible.
Getting your structure right can also save you a significant amount of tax. As I sort of mentioned before, individuals and trusts obtain a 50% CGT discount. Now, if the asset is actually owned in a trust, and we don't recommend this for all types of assets, by the way, it's really important to sort of get advice on what you're purchasing and how it should be structured. But hypothetically, say you've got an investment portfolio and you've got some shares in there and you've got some large capital gains. If it's in a family trust, you've got the flexibility to distribute that to multiple beneficiaries. So consider that, husband, wife and children, for example, all might be different lower tax rates, for example. You can distribute that gain capitalizing on their lower sort of marginal tax rates, and each one of those individuals will allow you to get the 50% CGT discount. Now, it's important that if you're using a family trust that you consider the streaming provisions. Now, what the streaming provisions allow for is, or basically guide you to, is that it allows you to sort of stream, as sort of the word mentions, different types of income to different beneficiaries. So, for example, if you've got one beneficiary who's got no income or very little income, you would likely want to distribute franked income to them so they can get the franking credits or the tax refunds back. Similarly, with capital gains tax, you wanted the ability to distribute CGT or capital gains events to various individuals that might not capture sort of franked income or unfranked income. You just want to utilize them to stream the capital gains tax to them. And it might be because they've got carry forward capital losses to utilize. So it's important to review your trust deed and ensure that your distribution minute captures who the capital gains event will be distributed to. And if your deed doesn't allow streaming, it can always be varied or updated to allow for a streaming provision.
One of the other things you could consider, this is not going to apply to everyone, of course, but whether you can utilise the small business CGT concessions to minimise or even eliminate any capital gains tax. Now, this would be most common, not always, but most common in scenarios where a business owner owns the property in which they operate their business from. And that's not an uncommon situation, whether it's owned, in an entity, personal name or self-managed super fund. It's relatively common. If you have used that asset for your business purposes for at least 50% of the time that you owned it, generally you can apply the small business CGT concessions. And these are really great concessions in terms of helping you eliminate or even at least reduce the amount of capital gains tax you pay. They're quite complex, and it's too complex to cover in this podcast, but it's the question is the asset that I own considered an active asset? And it needs to be to fall within these concessions. And most of the time, if it does, what it means that if you make a super contribution, you end up paying no tax. So instead of paying the tax, what you do is say, well, I'm going to put the money in super. Sure, it's locked away in super, but at least it's still your money and you're not paying it to the government. It's always something that we think about when we come across a client scenario, because they are so generous. We want to see if we all consider whether the transaction falls within the ambit of the small business CGT concessions.
Another avenue you can explore is spreading the capital gain over multiple financial years. So it avoids sort of triggering or the entire gain in 1 year, because, for example, you might be in lower income rates in 4 or 5 years as you wind down work or go to part-time or retire. So it might be beneficial to actually sort of stagger the capital gains events over multiple years. So a common example that we've had in the past is around parents who have purchased properties for their children, and it's all in their name, but want to sort of gradually give those properties to the children over a number of years, but they don't necessarily want to pay the upfront tax there and then whilst they're still working. So strategies we've explored is around selling part of the property, say 10-20% of the property each year over a number of years, into a family trust or to their children. So this allows you to sort of delay the capital gain tax and deal with the capital gain tax in each and every year on that small gain, and it increases the cost base for the person, for the trust or the individual that's receiving it. It works in a very similar way with shares. We explore avenues around gradually, for example, doing off-market transfers into super funds to get those shares into super, and doing that as a contribution strategy as well to offset capital gains tax. So it allows you to utilize multiple tax-free thresholds or take advantage of multiple rate rate gaps between spouses or family members between financial years.
Next, we can talk about owning a property or any assets really inside a company. And in the Investopoly podcast earlier this year, I recorded episode 350 where I talked about the benefits of that. So the benefits of owning an asset inside a company is that you can retain the gain within that entity, and sure, you pay a flat rate of 30%, whereas with the capital gains tax discount outside of a company, of course, it's taxed at your highest marginal rate or up to your highest marginal rate, 47%, but you get a 50% discount. So outside, the maximum you'll pay in terms of CGT is 23.5%. Inside a company, you pay 30%. So it's natural for people to go, well, that's more than outside, so why would I do it? The benefit of a company or crystallising capital gain in a company is, sure, yes, you've got to pay that 30% tax up front, but you get a credit for that tax. That means that you can pay a dividend out over the next 10, 15, 20 years, whatever you want, and spread that credit over that period of time. And essentially what it means is you pay the tax up front and then you gradually spread that gain over many, many years, and hopefully it means you pay less tax. Well, I did some numbers in that podcast and worked out that you can, potentially reduce the gain to about 10 to 14%. It just depends on how long you can spread that gain out for. Let's say 15% if you like. So it's 23.5% up to 23.5% outside of a company and potentially around 15% inside a company. Now, one of the downsides or potential downsides, again, depending on how you structure the company and how you structure the debt around the company, is negative gearing benefits. If you structure it correctly, you can maximize your negative gearing benefits and also minimize the capital gains tax. But it's really important that it's structured well. And what I'd say is go and have a listen to episode 350 in the Investopoly podcast, and we delve into that a little bit more detail.
Lastly, it's really important to time the sale to maximize tax efficiency. So try to be proactive about this rather than reactive. So I'll give you a couple of examples how you can benefit from it. So the first is around delaying the sale into a lower income year. So, you might be going on maternity leave or going into retirement or go down to part-time work or have a gap year or so forth, where your income might not be as high. So you would wait until that occurs for you to actually incur the CGT event and pay the tax, because between tax rates you could be saving yourself tens of thousands of dollars. Similarly with if you come to sell after 30 June, so as you know, the capital gains event is based on contract date, not settlement date. So if you were to push a sale to 1 July, so as an example, let's use 1 July 2025 as an example, you're likely not to pay that tax until 15 May 2026, so 15 May 2027. So it gives you a whole almost two years to benefit from the proceeds of those funds, where you could actually utilize those funds for investment before needing to pay the tax. It might also be prudent to realize certain capital losses before year end to offset gains. So bring forward the sale of dud assets to get the capital losses to offset against the capital gain that you're about to incur. Finally, something that we've done for a client recently is around the small business CGT concession Stuart mentioned earlier, is that he was about to lose his eligibility to obtain those small business CGT concessions. So what we did is we brought forward the sale of his business or the sale of his shares so that he can actually obtain those CGT discounts before he was about to sell the business in 5 years' time. So it's really important to try to be proactive about this, and it's really important to have these conversations with your holistic accountant as to what you're trying to achieve and what your goals are in the next 5-10 years, so that you can plan around it.
Of course, capital gains tax is only one of several considerations when we're thinking about divesting of assets, particularly property, for instance. We can have the best laid plan from a capital gains tax perspective, but if we're not considering market conditions, the best time of year to sell a particular asset, exposing the asset to the greatest pool of potential buyers, these sorts of considerations, we're probably doing ourselves a disservice. So capital gains tax is certainly important, but it's only one of the considerations. Also at the outset, we need to think about, before we buy the asset, we need to think about capital gains tax from a structuring perspective. But I should say that particularly if we're borrowing to buy a particular asset, that negative gearing benefits are more important to maximise generally than capital gains tax. Now that's going to depend on the asset you're buying and where most of the returns are going to come from, but as a general rule that is true. But we just wanted to talk about, some of the considerations and factors around capital gains tax and give people a better sort of understanding how it works and what we need to consider. But it's certainly something that a holistic accountant should be able to help you with. So until next week, bye for now.